Hi everyone, welcome back to our discussion of Chapter 10. Sometimes a company will acquire a new asset by giving up an existing asset. For example, a company might purchase a new delivery truck by trading in its old delivery truck. This is referred to as a non-monetary asset exchange. If the values of those non-monetary assets are not equal to one another, cash will be received or paid to equalize those values. When a company trades its old delivery truck for a new one, it's quite likely that the fair value of the new delivery truck is higher, so the company trading in the old delivery truck will pay cash to make up the difference. A gain or loss on the exchange is recognized for the difference between the fair value and the book value of the asset given up. The basic steps in recording non-monetary asset exchanges are as follows. Step 1. Record the new asset at fair value. The fair value is determined based on the fair value of the assets given up or the fair value of the asset received. In a normal exchange, we expect those two fair values to be equal. Step 2. Remove the book value of the non-monetary asset given. The book value equals the recorded cost of the old asset minus its accumulated depreciation. Step 3. Record any cash received or paid. Cash is used to equalize the fair values of the non-monetary assets in the exchange. Step 4. Record any gain or loss. The gain or loss on the exchange equals the difference between the fair value and the book value of the asset given up. If fair value is greater, then a gain is recorded. If book value is greater, then a loss is recorded. The gain or loss can also be viewed as the plug that balances debits and credits in the journal entry. Illustration 10-14a in your textbook shows a very good illustration of an asset exchanged at a gain. The Elkhorn Company traded its old laser equipment for the newer air-cooled ion laser equipment manufactured by American Laser Corporation. The old equipment had a cost of $500,000 and $400,000 of accumulated depreciation had been taken on the old equipment. Therefore, the old equipment had a book value of $100,000. And the old equipment had a fair value of $150,000. Elkhorn also paid American Laser $430,000 in cash as part of the exchange. Here is the journal entry necessary to record the exchange. Step 1. Record the new equipment with a debit for $580,000. This is the fair value of the assets given up. That would be the $150,000 fair value of the old laser equipment plus the $430,000 in cash paid as part of the exchange. Step 2. Remove the old equipment and the old equipment's accumulated depreciation from the books. So the old equipment account was credited for $500,000, which is the cost of the old equipment, and the accumulated depreciation was debited for $400,000. These two debits and credits completely remove the old equipment from the books. Step 3. Record the amount of cash paid. $430,000 was credited to the cash account. And step 4, record a $50,000 gain. The gain is computed as the fair value of the old equipment minus the book value of the old equipment. $150,000 minus $100,000 of book value equals a $50,000 gain. In this illustration, the $150,000 fair value of the old asset was known, and it was given to you right here. However, in a trade-in situation, quite often the fair value of the new asset is more clearly evident than the second-hand value of the asset traded in. For example, if it was known that the fair value of the new air-cooled ion laser equipment was $580,000, and you did not know what the fair value of the old asset was, then you could calculate this $150,000 fair value by subtracting the cash paid, $430,000, from the stated fair value of the asset received. $580,000 minus $430,000 equals the $150,000 calculated fair value of the old asset. The journal entry would be exactly the same, however. Illustration 10-14b in your textbook shows this same example, except the fair value of the asset given is less than its book value, and the exchange results in a loss. The Elkhorn Company traded in its old laser equipment for new laser equipment. The old equipment had a book value of $100,000, but the fair value of the old equipment was only $75,000. The same amount of cash, $430,000, was paid in the exchange. The new equipment is recorded at $505,000, which is the fair value of the old equipment, $75,000, plus the cash paid of $430,000. Elkhorn recognizes a loss of $25,000 on the exchange. That is the amount by which the fair value of the asset given is less than its $100,000 book value. Debit the new equipment, $505,000. Get rid of the old equipment from the books by debiting accumulated depreciation, $400,000, and crediting equipment, $500,000. Record the $25,000 loss on the exchange, and credit with a debit of $25,000, and credit cash for $430,000 for the cash paid. It would be unusual, but if the fair value of neither the old asset given up or the new asset received is determinable, then no gain or loss would be recorded on the exchange. The new equipment would be recorded as the sum of the book value of the asset given up plus any cash paid in the exchange. Basically the same facts with minor changes. The Elkhorn Company traded in its old laser equipment for new laser equipment. The old equipment had a book value of $100,000, $500,000 of cost less accumulated depreciation of $400,000. The fair value of the new asset and the old asset cannot be determined. Elkhorn paid American Laser $430,000 in cash. The new equipment would be debited for $530,000, which is the book value of $100,000 plus the $430,000 cash paid. Same debits and credits to get the old asset off the books. Debit accumulated depreciation by $400,000, credit equipment by $500,000, and credit cash, $430,000. Notice that no gain or loss was recognized on the transaction. It's time for another bonus break. Let's continue our Chapter 10 scavenger hunt. The bonus phrase for this video is for either the winter, Let's do a couple of concept check problems. The first, Arizona Pharmaceuticals exchanged laser equipment with a book value of $70,000 and a fair value of $75,000 for the newer model of laser equipment. In addition to the old equipment, $90,000 in cash was given. Arizona should recognize what gain or loss on the exchange. What is the amount of gain or loss that Arizona should recognize on the exchange? Please pause your video while you do your calculations and choose your answer. When you're finished, please start the video again to check your work. The correct answer is C, a gain of $5,000. In this problem, the fair value of the equipment given in the exchange was greater than its book value. Therefore, the exchange will result in a gain. The gain is calculated as the difference between the fair value of the old equipment and the old equipment's book value. $75,000 fair value minus the $70,000 book value of the old equipment equals a $5,000 gain on the exchange. Let's do another problem based on the same set of facts with some minor changes. Arizona Pharmaceuticals exchanged laser equipment with a book value of $70,000 and a fair value of $75,000 for a newer model of laser equipment. In addition to the old equipment, Arizona gave $90,000 cash in the exchange. At what amount should Arizona record the new laser equipment? Please pause your video while you do your calculations and choose your answer. When you're done, please start the video again to check your work. The correct answer is B. The new laser equipment is recorded at an amount equal to the fair value of the old equipment plus the cash given. $75,000 plus $90,000 equals $165,000. Well, that's all for this video. In the next video, we'll discuss self-constructed assets and begin a discussion on an important issue of interest capitalization rules. See you next time.